I'm going to talk today about 4 of the 10 commandments that Rob Carrick mentioned in his article in November of 2007 in the Globe Investor magazine. The first commandment that I'll review today comes from Paul Samuelson, who is a 1970 Nobel Prize winner in economics and an MIT professor. Samuelson says, "I tell people investing should be dull. It should be like watching paint dry or grass grow. If you want excitement, take $800 and go to Las Vegas." Somewhat cynical perhaps, but when you think that 2/3 of all returns that have accrued to equity investors over the last 90 years come from dividends and the reinvestment of dividends, you start to realize that you don't need to be invested in the next hot stock. You simply need to have a long-run plan and strategy and stick to it. Key in terms of Samuelson's point, I think, is don't get fooled by what you see in the media or what you hear from your friends at cocktail parties. In my experience, typically you only hear about the winners, you almost never hear about the losers. The next commandment that I want to review comes from Charlie Munger. And Charlie Munger is Warren Buffett's right-hand man at Berkshire Hathaway and as such knows a little thing or two about the investing industry. Charlie says, all intelligent investing is value investing. There are essentially 2 main camps in the investing debate, and that is growth versus value. Value investing is essentially buying great companies at good prices, being patient while they execute their business plan and grow their earnings over time, and in that way dividends and the fruits of the labor of management accrue to investors. The growth orientation involves looking for companies that will grow their earnings in excess of that their peers do. And while the 2 strategies to me aren't entirely mutually exclusive, there is solid historical evidence to suggest that a value orientation beats a growth orientation over time. The next commandment comes from Burton Malkiel. Malkiel was the author of A Random Walk Down Wall Street, written in the early 70s, and most of the logic still applies today. Malkiel says, "The one thing about which I'm absolutely certain is that if I pay less in fees, there's going to be more for me." Now, most investors would understand that there is going to be a level of fees involved in almost anything that you invest in, whether it's a discount brokerage where there's lower commissions, index funds where there's extremely low management fees, and then on the other end of the spectrum there are wrap accounts and other structured products that have quite a number of different costs embedded in them. I think the key takeaway is that investors should understand exactly what it is that they're investing in and what they're being asked to pay for. There should be full and complete disclosure of the fees that somebody is paying, and your advisor should be able to very clearly enunciate what the value proposition is with regard to their services. Ultimately, Malkiel is absolutely right that the less you pay in fees, the more is going to be left over for you in the end. The final commandment that I'll talk about today comes from John Bogle. John Bogle is an index investing pioneer, if you will, and heads up the Vanguard group of funds in New York currently. And Bogle's comments, I think, are particularly appropriate in the types of markets that we're seeing these days. He says, if you have trouble imagining a 20% loss in the market, you probably shouldn't be in stocks. After the last 5 years where equity markets, despite some dips, have really only gone up, I think it's very important for investors to remember that stocks do and can go down and probably should go down over some periods of time as the economy goes through the inevitable cycles that it's going to go through. This is where the onus is really on the investor to ensure that they know themselves, that they know how they're going to react in the event that markets do react adversely over a short period of time, and have their plan appropriately structured so that they're not going to get caught up into changing their strategy in response to what is simply an ordinary market move. Asset allocation becomes incredibly important in the process, and that really means making sure that you have the appropriate mix of equities, fixed income securities, real estate, and other assets in your portfolio so that you don't react adversely to something that has happened in the market that really doesn't have a bearing or shouldn't have a bearing on your long-term goals.